Your investment strategy functions similarly to a game plan for constructing a portfolio. However, it's critical that you pick one appropriate for your goals and circumstances. A 25-year-old should differ from that of a 65-year-old. We spend a lot of time preparing for our workdays, vacations, and car purchases, but we often overlook the most crucial plan of all, laying out our strategy for the future. In today's video, we'll be talking about the best investor strategies to outsmart the market. So stick around till the end to find out how. Welcome back to Reign Supreme, a channel to impact influential, powerful minds. Setting up your investment strategy is like buying a new car. Before you look at the different models, you need to figure out what style suits you best. And just like cars, there are many investment types to choose from when creating an investment strategy. When choosing the right investing strategy, there are questions that need to be answered first. What is your investment horizon? What returns are you seeking to achieve? What amount of risk are you able to tolerate? What are the funds in this investment to be used for? Answering these questions will ultimately help in building your portfolio. Determining what will be your breakdown between cash, fixed income securities, and stocks is a good start towards creating your investment strategy. The breakdown of your asset allocation ultimately depends on your risk tolerance. A conservative investor may prefer to hold 80% of his portfolio in fixed income and 20% in stocks. The reverse would be true for an aggressive investor, while a balanced investor will follow a 50-50 split. In terms of specific stock market strategies within your asset allocation, if you are a high-risk investor with a long investment horizon, you may want to include small cap and growth investing in your portfolio. If you have a moderate risk tolerance and shorter investment horizon, you may be more suitable for value and income investing. If you have a low risk tolerance and short investment horizon, you may want to focus solely on income investing. For those looking for companies that aim to do no harm, you can add socially responsible assets to your portfolio with relative ease. It's also important to adapt the investment strategy you are most comfortable with. Someone with a knack for choosing growth stocks may make that strategy the priority in their portfolio. Buy and hold. Buy and hold investors believe that, quote, time in the market is better than, quote, timing the market. If you use this strategy, you will buy securities and hold them for long periods of time. The idea is that long-term returns can overcome short-term volatility. This strategy is the opposite of market timing. The buy and hold investor will argue that holding for longer periods requires less frequent trading. Trading costs are minimized. This will increase the overall net return of the portfolio. Portfolios using the buy and hold strategy have been called lazy portfolios. This is because of their passive nature. Core and satellite. Core and satellite is a common portfolio design. It consists of a, quote, core, such as a large cap stock index mutual fund, which represents the largest part of the portfolio. Other types of funds, the, quote, satellite funds, each consist of smaller parts to create the whole. The main goal of this design is to reduce risk through diversification while beating a standard benchmark, such as the S&P 500 index. This type of portfolio will hopefully achieve above average returns with below average risk. The Dave Ramsey portfolio. Talk show host and finance guru Dave Ramsey touts a 4 mutual fund strategy. Dave's wisdom is in his simplicity. His methods are easy to grasp. However, the wisdom stops there. These 4 mutual fund types will often find fund overlap, meaning that there is little diversity. Further, lower risk assets such as bonds and cash are absent from the portfolio. Modern portfolio theory. Modern portfolio theory, MPT, is a method where you attempt to take a minimal level of market risk to capture maximum level returns. If you follow the tenets of MPT, you may use a core and satellite approach as described above. Every investor would like to achieve the highest possible return without taking extreme levels of risk. But how can this be done? The short answer is diversification. According to MPT, you can hold an asset type that is high in risk by itself. But when combined with other investments, the portfolio can be balanced so that its risk is lower than some of the underlying assets. Postmodern portfolio theory, PMPT. The difference between PMPT and MPT is the way they define risk and build portfolios based upon this risk. MPT sees risk as symmetrical. The portfolio construction consists of several diverse investments. These have various risk levels that combine to achieve a reasonable return. It is more a big-picture view of risk and returns. A PMPT investor sees risk as asymmetrical. They do not think of losses as the exact opposite of gains. Each investment is unique and evolving. PMPT sees that investors do not always act rationally. PMPT accounts for the behavioral aspects of the investor herd, not just the model that MPT follows. Tactical asset allocation. Tactical asset allocation is a combo of many of the styles talked about here. It is a style where the three main asset classes, stocks, bonds, and cash, are actively balanced to maximize returns and minimize risk, compared to a benchmark, such as an index. This style differs from those of technical analysis and fundamental analysis. It focuses mainly on asset allocation and then on investment selection. Choosing an investment style is no different from choosing investments. Each investor is unique. The best strategy is the one that works best for your objectives and tolerance for risk. Active trading. Active trading is hard. Few who try it have any success at all. Even fewer see stellar returns. Most active traders use some form of technical analysis. This research tool focuses on the changes in the price of stock, rather than on the measurements associated with the underlying business. As such, you can profit from much shorter-term moves. You have the chance to employ leverage with your strategies. With this trading strategy, you can work on any time frame from months, days, minutes, or even seconds. You use price data from exchange feeds or from charting platforms to see recent price patterns and market trends. You use these to predict future price movements. To bolster your chances, you must set parameters for levels of risk, reward, and win-loss rates. You may also employ a slower-paced version of active trading, known as momentum investing. The strategy says that even in random price movement, trends emerge. You may make longer-term investments meant to last several months, hoping that momentum will build and that the price will continue in that same direction. The idea is to buy high and sell higher. For instance, a mutual fund manager may seek growth stocks that have shown trends for consistent appreciation in price, betting that the rising price trends will continue. Growth investing. Growth investing using fundamental analysis is one of the oldest and most basic styles. This is an active investing strategy. It involves analyzing financial statements and factors about the company behind the stock. The goal is to find a firm whose metrics show the potential to grow in years ahead. This style of investing looks to construct a portfolio of 10 or more individual stocks. If you're a beginner, it can take a lot of time to do the research needed to make this strategy a success. But it is what many fund managers use to get returns. Growth stocks often perform best in the mature stages of a market cycle. The strategy reflects what investors do in healthy economies, gain higher expectations of future growth, and spend more money to do it. Tech companies are good examples here. They are often valued high, but can grow beyond those valuations when the environment is right. If you choose this strategy, you will analyze data from a business's financial statements. In doing so, you may arrive at a valuation, price of their stock. That will help you figure out whether the stock would be a good purchase or not. And there you have it, the effective strategies investors use to outsmart the stock market. Any of the investing strategies mentioned here can be done in a more or less aggressive manner. It just comes down to your preferred tactics. Here's a little gem for you. You can invest more aggressively at a young age before growing increasingly conservative as you get older. And with that, this brings us to the conclusion of today's video. Do let us know down in the comments how you feel about the smart investing strategies. We hope you've gained value today. And if you would like to see more videos like these, please hit the thumbs up, subscribe button, and notification bell. Till then, we'll see you in another video.